Good morning. And today's topic is basically risk management, and we'll be mainly looking at liquidity risk. Okay, liquidity. There are various types of risks in banking, basically in treasury and in your BFM topic. So one of them is liquidity. Okay, let's start. Yesterday I'd given you the homework. Which of the following foreign exchange operations have been useful in treasury management operations? So which have been useful in treasury management? Now let's look at one by one. Arbitrage and swaps, and both A and B. Okay, and none of these, forget this, D is out. Okay, now either A, B or C. What is arbitrage firstly? See here, this is related to your liquidity management. What is arbitrage? See here, buying from one market and selling into another. I'll give you a simple example. Let's say you have NSE and BSE, two stock markets, right, in India, NSE and BSE, right? Suppose I buy a Reliance share, Reliance, okay? I buy a Reliance share at 2400 on NSE, and immediately in BSE it is going on for 2402. Just for 5 to 6 seconds this rate exchange happens, this difference happens. On NSE it is roughly at 2400 and BSE it is roughly 2 or 3 rupees roughly. So suppose if I do the arbitrage means what? I'll press one buy button over here and press sell button over here, both for same quantity, means 100 shares over here and 100 shares over here. Okay, so if I do that, then I'll be earning what? How much? Suppose if I press a buy button, I'll be losing how much? 100 into 2400, so 2,40,000. If I press the sell button, how much will I be getting? 2,40,000, 200, right? 2 zeros ahead, so 200. So this much I'll be gaining in what period? Hardly half a second. Just pressing this button over here and on that side over there. That's it, isn't it? So such is a gain which we always look at. Okay, and this is known as arbitrage. Whenever we have arbitrage, we have to do it, number one, fast. Number one, very few seconds this difference lasts. Okay, number two, it is safest. Okay, now let me come to the swaps. What is swap? Swap means basically it has two legs. Okay, one leg is fixed, and other is floating. Okay, for example I'll give you, that is called as swap. Okay, I'll give you an example. Suppose if I take 1 lakh rupees from you, 1 lakh, okay, and guarantee you that I'll be paying you 7% rate of interest. Now what do? I take this 1 lakh and invest it in stock market. Okay, so in stock market I may get 12% in a year, or 50% in a year, or minus 50% in a year. It can happen that whole of my amount goes down, right? So this is floating and this is fixed. This I have guaranteed you, I'll give you 7%. So this is known as swap. One leg is fixed, other leg is floating. Now swaps are of various types. It can be currency swap, it can be commodity swap, anything, but logic remains the same. One leg fixed, other leg floating. Okay, got it? So the answer over here is what? Answer is C, both A and B. Okay, risk in trading securities may arise from the following activities. So trading securities means what? Bonds. Securities can be anything. It can be bonds, mainly bonds. When we deal in treasury, we deal in bonds mainly, or it can be stocks, anything. Okay, so it arises due to what? Foreign exchange transactions, equity holding, lending and repos, and all of these. So this risk arises because of these, all these three, or only something between these. Okay, what can be the best answer? Foreign exchange transactions, yes. Because why? Suppose if the dollar rate goes down or goes up, okay, accordingly my local transactions are also affected. Okay, because inflation is affected immediately. So inflation is affected means what? Here it's like this. If inflation goes up, what happens? The securities interest rate goes up. here inflation is high, so the government or the central bank will try to increase the interest rate. So interest rate goes up. Interest rate I will go up. Okay. So inflation up, the government will or central bank will increase the interest rate. Because of this, what will happen? The price of the security goes down. Okay, so price will go down. So definitely this will affect the securities. Equity holding, obviously. Equity holding means what? Whatever shares I am having. If I am trading in those shares here, as I told you, security doesn't mean only bonds. It can be anything. Majorly bonds, but it can be equity holding also, right? So if I am trading in securities, it may definitely this risk may arise because of this equity holding and lending and repos. As RBI changes the repo rate, okay. So once the repo is changed, the whole market gets changed. Why? Because banks get rates at a higher or lower rate, what depending on the repo, right? So that's the way it always works. So all of them A, B, C are the answers over here. Which of the following is not an agency service of the bank? Agency. Agency means what? Understand, commission. There should be commission involved in this. For example, insurance. Insurance is an agency service. Locker is also sort of agency service, because what are you doing? It's not your basic core banking product. Okay, it's a para banking. Okay, so let's see which of the following is not an agency service for the bank. Extending credit, escrow account, merchant banking service, and insurance selling. So which of them is not the agency service? Agency means what? It should not be a core product. So extending credit is a core product of the bank or not a core product? What are the basic products of bank? Deposits and loans, right? So extending credit is what? It's a core product. So we want not. So this is not the agency service. Okay, it is a core product of the bank. Escrow is okay. What is escrow? Escrow is similar to that of the joint account. Okay, suppose A and B, this is a buyer and seller. Okay, A and B are he is a buyer and this B is a seller. Okay, so what happens? A and B don't trust each other. They don't want to open LCs also, because LCs cost them. So what do they say? They say, okay, we'll open a common account. This is called as escrow with a bank. Okay, escrow, and in that CROW, and in that account they'll put this A is going to give them money, so A will put the money over here, the rupees, I'll write it. A will put the rupees over here. Now this account can be operated by the signatures of both, number one, and number two, this bank acts as an agent. In this case, bank will give the money to B only when so and so conditions are fulfilled. It's similar to that of the LC. Okay, so bank will tell B that produce these documents, only then the money is going to be given. Okay, so this is escrow. It's a sort of this savings account joint type. It can be operated by the signatures of both only. Okay, so that is the agency service. Merchant banking services, that's obviously agency service. Merchant banking means what? Merchant banking is related to IPOs. Okay, whenever any company issues an IPO, so bank acts as a merchant banker. Merchant banker means it gives them the method or gives them the process of bringing that IPO in the market for the fees, obviously. Insurance, you already know that it's a agency service. We get commission on that. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study material plus live classes, ebooks, tests, everything. So download it immediately. What is the off-balance sheet risk? Off-balance sheet means what? Here, understand. In balance sheet of any bank, you check any balance sheet, you will get only 2-3 things. Number one, you will be getting the paid items. Paid items means where cash actually goes, loans. And then deposits, where cash actually comes. So off-balance sheet means what? These are the items where the cash does not go immediately, like LC, bank guarantee, all these. Okay, so there, if I give somebody a bank guarantee, it means that I am not giving the cash immediately, isn't it? So that becomes an off balance sheet item. So What is the off balance sheet risk? So it is contingent in nature. Contingent means what? It is not to be paid immediately, but in future. Contingency means future. Okay. So I don't have to pay right now, but I may be required to pay in future if the things arise, right? It can occur on account of issue of guarantees committed, credit lines, and issue of LCs. So it can occur because of this, definitely, because the issue of guarantees. What is a guarantee basically? See this. This is a, let's say, bank. Okay, you are the bank over here. Now what happens? This Mr. A is a client of yours. He is, let's say, contractor, road contractor. So Mr. A requires a contract from, let's say, municipality or state government. Okay, let's call this state government. Mr. A requires the contract of road from the state government, but state government tells you that tells A that okay, we will give you road contract subject to you produce a guarantee from your bank. Now this guarantee is given by you. Of course, you don't give it for free. You will charge A's collateral. Collateral means mainly financial collateral, FD generally. You will charge FD of 110% minimum, okay, and then issue this guarantee, okay. So this what happens? Suppose if Mr. A gets the contract and he does not design the road, does not do work, okay, does not work. In that case, what will happen? He does not do the road properly or something mistakes he does. So the state government will come to you and they'll ask you, see, you had given me the guarantee, kindly pay me right now for the full amount which you had guaranteed. So there, that is meant by the contingent liability. Future, is the bank giving the money immediately to the state government? No. If A does not perform, so that occurs because of these guarantees. And similarly LCs also, okay. LC is a direct method of payment. It's not if he does not work. LC means you have to pay. Bank's commitment may happen on account of failure to meet payment obligations. Correct. So bank's commitment may happen on account of failure of who? Of the customer. So if A does not perform, only then bank will pay. So the answer is what? Right? All of them. Which of the following statements is correct? Now we want only correct. Huh? The funding risk may arise from the need to replace net cash outflows due to the unanticipated withdrawals. That's right. Unanticipated withdrawals. When does it happen? This is called as run on the bank. Run on bank. This is a separate concept in banking. Huh? Run on bank means what? People come for withdrawals. Unnecessary withdrawals. Something news comes about your bank and everyone comes into the banking system for withdrawals. So these are all unanticipated. In such case, we always face the funding risk. Because where's the money? After all, you will be needing notes, right? Cash if somebody comes for withdrawal. But where is the money in that case, right? Time risk arises when the performing asset turns into NPA. Yeah. So A was alright. What about B? Performing asset turns into NPA. So NPA means what? I am not getting the interest. What is the purpose of loan for the bank? Bank gives this, let's say, 100 rupees, right? And the customer gives every month, let's say, 10 rupees plus interest, right? Then 10 rupees plus interest, whatever it is, right? 10 plus interest, it goes on and on, okay? Now if it becomes NPA, then what happens? This, suppose if the loan becomes NPA over here, you won't get this 10 rupees, neither this interest. So time risk means what? I am not getting the money on time which I had anticipated. So time risk arises when the performing asset turns into an NPA, obviously, isn't it? So B is right. C, call risk arises due to crystallization of contingent liabilities. Now this is what we discussed earlier. See this part. What is this? This is called as crystallization. Means the A contractor is not performing, so that's why state government is coming to you for payment. So this coming for payment is known as crystallization. Crystallization means the future liability which I had taken, now I have to pay it. Okay, that's called as crystallization. Okay. So this is also true. So what is the answer then? All of these. Many of the questions are all of these over here today, right? Because you need to understand all the nitty-gritties over here. That's why they have been taken. Okay. Subscribe to Officers Adda 24/7 YouTube channel. In this channel, you'll be getting all the latest updates on JIB, CIB, and various banking exams. Number two, you'll be getting free YouTube series. Right now, what are you watching? Free YouTube. Same thing. So click on the bell icon, subscribe to the channel, do it immediately. Why? Because once you click on the bell icon, the latest videos on daily basis, you'll be getting it. Okay. The features of interest rate risk are, interest rate risk means what? Interest rates going up, interest rate going down. Why does this happen? I told you just in the first question, I think so, in the homework part, or no. Yeah, in the first question I told you. How does the interest rate work? Here, interest rate works when the inflation, let's come to inflation first. When the inflation goes up, means huge inflation, okay? Then what happens? The central government or RBI comes into action. What does it do? It wants to reduce the money in the market. How will it reduce? Number one, it will raise the interest rates, means repo rates, repo and CRR. Okay, these are the two tools in the hands of RBI. RBI will raise this. So once these rates are up, what happens? The interest rate risk means what? The interest rate for loans go up, the interest rate for deposits also go up. Both of them go up. Okay, so for depositors it's good, but for the loan takers it's very difficult. Okay, so the features of interest rate risk are, it is the exposure of the bank's financial condition to adverse movement in the interest rates, right? Adverse movement. Is this an adverse movement? Yes, of course it's an adverse movement for the bank. Why? Because if the interest rate goes up, what does it mean? I'll have to give more on deposits. More I'll have to give on deposits, right? Deposits. But I'll receive more on loans also. But the problem, there's a problem over here. If I increase my interest rates on loan, customer will run away. Okay? So more on deposits it is, more on, I have to pay more on deposits if the interest rate goes up, right? And I get more on loans, but the customer will run away. So I can't take that for granted. Okay, so it's an adverse movement in the banks from the bank's angle. It has no effect on NIM. It has no effect. No, that's wrong, right? So this is out. It may not affect the market value of the equity. It may not affect, means if the interest rate goes up, okay, generally if you see, as the interest rate goes up in any market or stock market, the rates of the stocks, okay, the rates of the stocks will definitely go down. Why? Because money becomes costlier. It's as simple here. If the rates are higher, it means what? Loan rates are higher. It means what? The cost of loans is higher, is costlier. So as the money becomes costlier, people will get less money. So less money means what? They'll buy lesser in that stock. So that's the thing happens. Okay, so the answer is only A over here, not all of these. Okay, which of the following is not a mismatch risk? Remember, not. Okay, not a mismatch risk. Holding assets and liabilities with different maturity dates and amount. So not a mismatch. Assets and liabilities, it will definitely result in mismatch, isn't it? Right? Adverse movement in interest rates. This is not related to mismatch actually. Mismatch means what? See here, it's very simple. This is my balance sheet, this is my asset, this is my liabilities. Okay, if I'm having assets of let's say 100 rupees and having liabilities of 200 rupees, I'll be having a mismatch over here. Or if I'm having the loans, asset means what? Loans. Okay, if I'm having loans where I earn the money, if I'm having loans for let's say 1 year or 3 years, okay, and liability means deposits, right? Deposits. So if I'm having deposits for let's say 1 year, okay, so what will happen? I'll be facing the mismatch. Say this loan guy, whoever I'm given the loan, this person will pay me after 3 years, but this person will come to me immediately after 1 year for getting the amount, right? So this is known as basically this gap, this difference is known as the mismatch actually. Okay, and what about this B? B is not related to this mismatch at all. It is an interest rate risk. Means just now we saw it, this question, right? This question and this earlier one, this one, where was it? First question it was, right? So that is basically the point. Okay, when the liability is repriced on the maturity date and this causes variation in the interest rate. So this is a mismatch risk. Why? Because liability is repriced means what? What do you mean by repricing? See here, whenever I have to pay, suppose if this is my liability or deposit for 1 year, on 1 year that customer comes to me and asks for money. So suppose if I don't have money or I don't want to give that money back to that customer, so what will I do? I'll reprice this asset. I'll tell that customer, see, I was having this FD at let's say 7%, now I'll give you 7.2, but don't take it out. Keep this. So this repricing will definitely, if I increase 0.25 or 0.5 over here, this will definitely impact my loans also. So that is known as the mismatch risk. So C is also true over here. But what is not true? We want this. What is not true? So the correct answer is B over here, not a mismatch, right? What is the yield curve risk? Yield curve means what? It is similar to that of the interest rate risk. Here, interest rate risk and yield curve risk, one and the same. Okay? Means if the yield of the bond, what is yield basically? What is yield curve? See here, yield curve means it's like this. Whenever there's a bond, okay? What do? We plot the yield curve of various bonds under same category. Remember, this is important. Suppose if I am plotting for AAA rated bonds, so I have to plot for AAA rated bonds of various maturities. This will be of 3 months, this will be of 10 years. I'll have to plot these different maturities of the same rated bonds. So the curve which comes because of this yield means what? Asking rate, what people are asking, demanding, okay? So this curve, what is the demand for short-term and long-term bonds from the public side, is known as basically yield curve, okay? So what is this yield curve risk? When two different instruments maturing at different time horizon for pricing assets and liabilities. Okay, yeah. Two different instruments, see this, 3 months and 10 years, okay? Maturing at different time horizon for pricing assets and liabilities. That's basically a risk, right? Means I take a loan for 3 months, okay, and give a deposit for 10 years. That's wrong, isn't it? That's the basic logic of this line. There may not be parallel movement in the interest rate for both the instruments. That's obvious here. 3 month, whenever this yield curve is inverted. What do you mean by inverted yield curve? It's like this. What happens? 3 months bonds are at higher interest rate and 10 years bonds are at lower interest rate. When there is the inflation, when there is a recessionary trend going on, okay? So there may not be parallel movement in interest rate. That's also true. So A is true, B is true, okay? What about C? Non-parallel movement in the yield curve may affect the net interest income. Obviously it will affect. See this, 3 months and 10 years, okay? So if I am having, why do we take so long? We can take it 3 months and 6 months also. Okay, 6 months. Instead of 10 years, I can take it 6 months. So suppose if I am having a loan of 3 years and deposit of 6 months, and the maturity changes in different ways, different proportions, non-parallel movement. So in that case, what will happen? There will be a change in my NIM, net interest income, right? So answer is D, all of the above, right? Which of the following statements is correct regarding yield coverage? Homework, okay? A bank need not evaluate the movement in yield curve and impact the curve on the portfolio value and income. So need not, did I say what? Needs, okay. A bank needs to evaluate the movement in the yield curve and impact of the curve on the portfolio and value and income. If the liability is raised to 364 days T-bills and used to fund an asset of 91 days, it would result in yield curve risk in both A and B. So now this is up to you for searching, okay? I'll answer this tomorrow, okay? Do the homework, everyone. Now let me come to the batch. See, this batch has just now started, just 1 day back, okay? So you can definitely join the batch. All the 4 subjects are covered: ABM, BFM, ABFM and BRBL. Then number 2, there are all the elective, all these objective questions, case studies, every numericals, everything is covered. 80% off is going on right now. Remember this, 80% off and double validity on Mahapacks. So go for this immediately, because these offers don't come every now and then, okay? Use the code Y432. How to use this? Okay, let me show you. Let's go to Adda 24/7 live. Okay, let me go to Adda 24/7 live. Okay, if you're having the app, go on the app. I would suggest you go on the app only rather than going on for the site, okay? In the app you are getting 1% extra because of that coin system, okay? There's a coin system available over here, and if you collect the coins, you'll definitely get a huge discounts over there, 1% extra. So click on JIB and CIB over here. Okay, click on CIB 23. Clicked. Now you'll see the details of the batch. See this. Click on the first batch. Okay, April 3rd. You'll see the details of the batch. What are the dates, timings, what are the study plans, everything you'll see over here. Now look at the fees part. Importantly, remember recorded videos are available. So if you miss out on any class, you can get back to it definitely using the recorded classes. Okay, 2 interactive classes. You can ask the questions there and then itself. Okay, click on more offers. Okay, click on more offers. Put the code Y432. Click on apply. Look at this, 80% off. So 23,999 reduces to 4,799. Such a huge discount you are getting, isn't it? Validity is 6 months, so go for this batch. In fact, I would suggest go for Mahapack. In Mahapack, you are getting 15 plus batches per subject. Look at this, JIB, CIB, Mahapack. Click on this. Okay, now click on CIB ka Mahapack. Clicked. See the details. You'll go through the details over here. 15 plus batches for ABM, BFM, ABFM, BRBL. Then mock tests are available, ebooks are available, everything is available. Okay, now look at this again, all the 15 batches you have the recorded sessions. Okay, so now click on more offers, put the code Y432. Never forget this code, it gives you 80% off. Okay, and in the app 1% extra. Okay, so 6,999.80. Now 34,999 reduces to 6,999.80. 80% off you are getting. Okay, so go for this immediately. Why? Because such offers don't come every now and then, and importantly, exams are in June, just 2 months. Okay, so go for it right now. I'll be coming back tomorrow with another series. Till then, bye.